This week we need to talk about monetary policy and how the Federal Reserve works in our economy. Just a quick review of a couple of things we talked about last week. In the United States, we have what we call a fractional reserve banking system, and that means banks are required by law to hold a percentage of their deposits on reserve. By reserve, we mean they have to hold them in their vault, they have to have a bank account in a larger bank, or they have an account at the local Federal Reserve Bank. The percentage of deposits that a bank has to hold is called the required reserve ratio. And remember, we use that required reserve ratio to figure out how much money could circulate in the economy. But let's get back to that. Let's first look at the Federal Reserve System. All right, the Federal Reserve is the central bank of the United States. It is commonly called a banker's bank. It's made up of banks. You and I cannot make deposits there. Only banks make deposits there. It was established in 1913 in response to a banking crisis in 1907. And it is the Federal Reserve who actually conducts monetary policy in the United States. Monetary policy, remember, is changing the money supply in order to change the economy. The Federal Reserve has three tools that it can use to change the money supply. They are changing the required reserve ratio, changing the discount rate, and conducting open market operations. And we're going to look at each of these in turn. If you recall, last week we looked at how the banking system creates money. And it creates money by lending and relending the same money over and over again. And we used the money multiplier equation here to calculate the total amount of money that could be created in that example we used. And remember, we were able to create $1,000. And that was based on the fact that our required reserve ratio was 10%. So what happens if the Fed changes the required reserve ratio? If they increase the required reserve ratio to 20%, how does that change the amount of money we can create? Well, we see that we changed our required reserve ratio to 0.2, which is 20%. 1 divided by 0.2 is 5, which means we could create $500. By increasing the required reserve ratio, we decrease the amount of money that can be created. Well, that makes sense because the required reserve ratio is how much of deposits banks have to hold. So if they have to hold more money, they can lend less out. So less money can get created. Right. So by changing the required reserve ratio, we can change the amount of money that gets created. In reality, the Fed doesn't change the required reserve ratio frequently. I may be wrong, but I think the last time the required reserve ratio was changed was back in there was a major banking reform act in the 80s. I think that was probably the last time that got changed. We can now look at the discount rate. The discount rate is the interest rate the Fed charges banks to borrow from it. Okay. So banks have to hold required reserves. why would a bank ever want to borrow from the Fed? Well, it comes back to those required reserves. The bank only can lend out their excess reserves, right? If part of them have required reserves, that has to stay there. Well, there's a little loophole here. On the last Wednesday of the month, banks must have in their reserve account enough money to cover their required reserves based on deposits the second Wednesday of the month. There's a lag here. The end of the month, you have to have enough reserves to cover what your deposits were on the second Wednesday of the month. Remember, this requirement went in 1913. There were no computers. It took a while for banks to get their books balanced and everything. So there's a little lag time here. And it could have been a problem if banks had lent out too much money, if they didn't have enough to cover their reserves. So this is where the discount rate came in. The Fed will lend banks money to cover their reserve account. Now, this is interesting because banks realized that not only could we use these loans to cover our reserves if we made a mistake, but they could also purposely lend out reserves. For example, if the discount rate is 2%, the banks say can lend out money at 5%. The bank would still make 3%. All right, that's good, right? Interest rate the banks are charging is fairly low. Not a problem. People will be coming in to borrow the money. But if the Fed increases the discount rate and the bank still wants to make 3%, it's going to have to charge 8% on the loans that it makes. Remember, the higher the interest rate you have to pay, the less likely consumers are going to come in to borrow the money. So the banks can make fewer loans when the discount rate goes up. They can make more loans when the discount rate is low. So the Fed, by adjusting the discount rate, can encourage or discourage banks from making loans. The final tool that the Fed has available to conduct monetary policy is open market operations. Open market operations is the buying and selling of government bonds. Now remember what a bond is. A bond is simply an IOU. So when you buy a government bond, all you're doing is lending the government money. Right? So if the Fed decides that they want to sell bonds, they go to the Open Market Commission, which is headquartered in the Fed branch on Wall Street, and tells the Open Market Operations Committee to sell bonds. The members of the commission or the employees of the commission reach out to banks, brokerage firms, things like that, and says the Fed is selling bonds. So the banks, the brokerage firms contact their big depositors, their investors, and say, okay, do you want to buy some government bonds? This is the interest rate they're paying. This is when they're going to pay them back. And let's say you have $10,000. That's not doing anything. $10,000 is the minimum for a treasury bill. And so you tell your brokerage, yeah, I'm going to buy a government bond. So you turn over money because you're buying something, right? So you give the Fed money. In return, they give you the bond, which is a promise to repay at a later date, at a certain interest rate. Well, what does the Fed do with that money? If it's selling the bonds to conduct monetary policy, it takes that money and it sticks it in a vault someplace. So what's happened to the amount of money in circulation? Well, that money sitting in a vault is not circulating. So the money supply decreases. If the Fed wants to decrease the money supply, it will sell bonds. On the other hand, if the Fed wanted to increase the money supply, it could use what we call expansionary monetary policy, which means buying back bonds. So the Open Market Commission decides it's going to buy back bonds. It wants to contract the money supply. It has its people call the banks and the brokerage firms. It says, tell your people we want to buy back bonds. You get contacted by your broker, and your broker says, the Fed's buying back bonds. Do you want to sell your bond? You decide, yeah, I want to sell my bond. So the broker tells the Fed, yes, I got somebody who wants to sell their bond. You turn your bond over to the Fed. They give your money plus your interest rate. And now you have the money. What can you do with it? Well, anything you want. Short of burning it, anything you want. You can go buy another bond. You can go buy a new house. You can go buy whatever you want with it. I don't know. However, Big Macs you want. I don't know. You could spend your money. But the key here is that money is now being injected back into the system, and it stimulates the economy. It causes the amount of money in circulation to increase, and it stimulates the economy. Now, of the three tools the Fed has available to it, we've already seen that the required reserve ratio is the least used tool. Open market operations happens to be the most frequently used tool. The Open Market Commission buys and sells bonds almost daily. All right. We've seen recently that the manipulation of the discount rate also gets used, but it doesn't get used as frequently as open market operations. So familiarize yourself with the tools that the Fed has available to it. What we now have to turn and look at is, what is the impact of using both monetary and fiscal policy on the economy? Should the government be intervening in the economy? And that's going to be our next lecture.